Cause you feel my mind, or you feel my mind. We could build a dream, start up something new. And the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? You will fall asleep.
Hello, everybody. Welcome to VC Masters on the Pod TV Network. I'm Nick Pellavito. I will be your moderator for today's show. And today's show, we have a very exciting topic we're going to discuss. Something that people don't look at very often. What wins, the venture capital or the S&P 500 investments? And when I looked at this, I was going, where can you find studies on it? And I went to Cambridge. Of course, the internet knows everything. And they actually did a study on it. And here's what they came up with, which I found to be very interesting before we bring in Dr. Azar. They said from 2000 to 2020, the S&P 500 returned 5.91, venture capital is 5.06. So it's pretty close, but looks like the S&P 500 won out. However, let's take a look at it again. From 2010 to 2020, the S&P 500 was 13.99, but the venture capitalist returned 15.15. So all of a sudden you see an asset class, and the thing is the studies go on, that look like you could actually do better, in some studies twice better, being in a VC or rather than being in the S&P 500, which is the benchmark for returns. With that, we're going to bring in Dr. Salman Azar, who's the GP for the Azimuth Fund, and also a professor at Duke University. I don't know if you know about these studies or not, Dr. Azar, but I found them fascinating that this asset class, in many cases, will double the S&P 500. So I'm wondering what your thoughts are on that.
Well, I have controversial thoughts as usual. I look at these studies and I kind of smirk to myself because I have a data analytics background. So let me explain why I do that. When you do a study of S&P 500, you are essentially doing about 500 stocks. They can change a little bit, but there are big winners there and there are big losers there, and there are all these things in the middle. All these things in the middle really don't matter. It's really the big winners and big losers that determine where you end up for S&P 500. In VC, that is even more exaggerated. And the reason for that is that about 90% of the VC investments fail. And about 90% of VCs wannabe fail. They fail after the first fund. They can't return money to the investors, or if they can, it is like 1x, 2x return. In other words, they have returned just the cash or just 2x. And because you have this illiquidity for several years, you need to return twice or thrice or sometimes even 5x in order to make up for the time that you have invested this money. In order for me to explain this, let me kind of like switch gears and explain like studies when they, this is, by the way, the same thing happened if you go to Visual Capitalist. They would have a study of US map in terms of cost of living by state. That is absolute BS. And I'm going to call BS on this for this reason. If you are living in San Jose, California, that is very different from living in Fresno, California, or any part in Central California. The Central California cost of living may be very similar to someplace in North Carolina. So when we are looking at these averages and looking at these studies, it would be a lot better for them to compare like the top S&P 500 stocks. And by the way, those are not necessarily Dow Jones 30 if you're thinking about that, to the top VCs and the bottom to the bottom VCs. And what you will find is that the top VCs are beating the pants off the top S&P 500 stocks. And the bottom VCs are getting their pants beaten by the bottom S&P 500 stocks. In particular, when you lose money in a VC, you typically lose all your money. When you lose money in an S&P 500, at least if you have a basket of even the bottom stocks, you are not going to lose all your money. You're going to lose a certain percentage of money. So top VCs beat the top S&P 500 consistently. And the bottom VCs lose out to the bottom S&P 500 consistently. So that's really my take on this. there is also a saying, averages are awful. When you're looking at, for example, retail stores, and you have a number of stores like Costco or Walmart or something like that, you have this thing where you know an average per store average or PSA number is used in that in those kind of things. And once again, that is misleading because the top stores, top Walmart stores, are the ones that dominate their performance, and the bottom ones do not. If you're looking for opportunity, there are the bottom ones. If you're looking for where the money is, those are the top stores. And the same thing happens in S&P 500 and VC. It is even more exaggerated.
Wow, that's quite illuminating. The thing is, so at the top level, let's say the top 1% or top 10%, it can be a greater disparity than you can if you're in the middle of the pack or the end of the pack. In the end of the pack, it's a great disparity going down. Okay, yeah. But let's talk about another problem that the VCs have in the marketplace, besides the liquidity issues. And I'm going to go beat on my friends, called the here we go. Something I get back not approved by the broker dealer. Okay. And what I'm saying is that a lot of the securities, and we beam out to a lot of financial planners, financial advisors, people that are securities licensed, they're FINRA licensed, and they come back with, I can't talk about this because the product has not been approved by my broker dealer. So this is not unusual out there, because it even happens in the area I work in with major life insurance companies and major annuity contracts. They'll say, well, that product hasn't been approved by my broker dealer, even though it's a $30 billion, 100-year-old company. They can't discuss it. So is there a problem out there? Because the distribution of financial products are generally done by financial advisors, and the financial advisors can't even discuss this asset class. So what are your thoughts about this? Because I'm looking at an asset class, which is the VC asset class, that is not being shown to their clients because, frankly, they can't.
Yeah, so that is a huge problem for VCs, particularly small VCs like myself, that we cannot openly even solicit funds. So on this show, for example, I can't go and ask, hey, give me your money and I will make money for you. I can't do that. So I'm not doing that, by the way. I'm just kind of like telling you that I can't do that. So that is kind of one aspect of things. The other aspect of things is that as a broker dealer, you can solicit funds, you can and solicit prospective clients, but a lot of broker dealers don't approve this because they don't understand it. And the other reason is that they have this way that has been working fine, and they don't want to deviate from it. So, I was talking to Dennis Stearns, who's a very experienced financial manager, has, well, I guess I can't say that on public, but has a lot of money under management. And basically, I asked him for advice on this, and he said, well, 80% of the financial advisors, RIAs, or whoever you would go to, are basically not even looking at that class. 20% would stop and smell the roses, but they would be very reluctant because they have all these regulations, and these regulations work fine if they stay within a narrow thing. So it is, I actually had an interesting thing. I was talking to a broker dealer, and we have a very standard kind of agreement, and we kind of deviated from a little bit because it doesn't scale if I have a separate agreement for every broker dealer. And he wanted a number of changes, and we just said, no, this model doesn't scale for us. So for broker dealers, that problem is even magnified because they're dealing with a number of different securities, and for them to kind of like disrupt their process for a few $1 million doesn't make sense. There was kind of an experience that I had, that I was told that you have to at least bring us $2 million of business for us to even think about deviating from our process. So in order for us to come to a broker dealer, what they were saying is that have $2 million of investors that you bring and pass through us, and then we can spend this time to approve you. So, and then we have to pay the fees on people that we bring in, and then it comes on the other side for us in terms of volume, because once we are approved, then they can share it. And that, by the way, is also an education problem among investors, because there are several things about VC investing that are actually safer than public investing, such as the liquidation preference, which preserves the money that you have invested. That needs to be given back to you first before any other money is distributed. That means that if you invest in a company that is worth $1 billion, and the money into that is 200 million, that 200 million needs to be paid first. So that company can actually lose 80% of their value. And as an investor, you'll still get dollar for dollar back. You cannot do that with any common stock that is out publicly traded. So most broker dealers or most financial advisors don't even understand or don't even know about it, let alone understand it.
Yeah, there's another group that we talk about and talk to, and it's a growing area. It's called the family office. And not only there's family offices, there are people that may not be just from one family, but multiple families that create these family offices, which have advisors like CPAs and attorneys and financial advisors. Do you think that they're discussing the VC market as an asset class that could be diversified into? What are your thoughts about?
Definitely. So family offices are getting big time into VCs, and they actually poured a lot of money into VCs about 10, 15 years ago. However, these days they are struggling a little bit with liquidity, and we can talk about liquidity separately. So that's one of the reasons that they are running a little bit dry. Actually, I should say a little bit low on dry powder because of that. Other than that, they are very interested in VCs. They generally tend to be more conservative than most of the institutional VC LPs. So, I mean, actually, the way to raise a VC fund, there are several ways, but one of the ways is to get an anchor investor. And that anchor investor usually puts in something, a huge percentage of the total money raised. Family offices are a little bit reluctant to put that much money in as an anchor investor. So they are really following other money instead of taking the lead on some of these things. One of the reasons for that is that a lot of family offices are not run by families anymore. They are run by people, the same kind of group of people that are in the broker dealers or IRA or those kinds of financial advisory professions. And there is kind of like, a fear of losing your job is much higher than the excitement of going to the next level. Because they can get fired for making the wrong decision, but they cannot get fired for letting go of an opportunity. So I kind of had a friend who said my worst investment decision was Google. And I said, what do you mean Google? And I said, well, I didn't invest as an early investor in Google and look at the money that I could have made with that. And I said, that's not the money you could have made. Right? That is the money that you lost because you didn't make it and you didn't make that Google investment. So family offices are a little bit reluctant to take the plunge, but they are okay following. So there is a disparity or, case-shaped disparity, as we learned from COVID, where the big funds are getting bigger and the small funds are struggling even more.
Okay, it brings me to another topic when it comes to investing in venture capital. It's the information out there. Now, normally when I look at securities, I can go to a 10K. I usually bypass the annual report because the annual reports always say, what a wonderful job we've done. And it's glossed over and it's made by management. But I quickly go to the 10K because the 10K, you have to be a little bit more detail oriented and disclose. It's kind of a brick and mortar. In other words, you're looking through that. But let's go look at the information for the VCs. And this is where I run into a problem. Where do you get any information relating to the VC market space?
So this is one of the best kept secrets of successful VCs, that they have access to information that other VCs, the general public definitely doesn't have it, but other VCs don't have it. I was talking to a friend, a longtime friend, let's call him Casey because that's his real name. He is investing in all these companies that we know for a fact have big issues. but they have put this lipstick on a pig, and they're getting all these amateur investors to invest. So if you are my friend and you're listening to this show, please don't use your own money when you're using your own brain. If you're using your own brain, use someone else's money. Well, actually, that's a bad idea either. Better idea is use somebody else's brain when you're using your own money who has access to information. So there's a huge inside long short market. There are hedge funds now, they're doing long shorts on privately held assets. And we have access to what people are going long in, what people are going short in. I exclusively am investing in companies that I'm already invested in, and there are about 250 of those. And what I do is I look at the investment reports that they send me, and just by the nature of things, they have to report the details and financials. And as you see, a lot of them actually put lipstick on a pig and say everything is right. A lot of them don't even say anything and don't give quarterly updates. So I look at this first, the subset, which is generally less than 50% of those who actually give some kind of real analyzable information, which is basically their financials by month, sometimes by week, sometimes by quarter, whatever that is. And that's really the key information that I have, in addition to what kind of strategy they have, what kind of new products they're launching. And that is something that I don't have on companies I haven't invested in. So why do I need to look at companies that I haven't invested in when I have no information, no inside information, by the legal inside information? I would rather look at companies where I have legal inside information and then invest my money and my investors' money wisely into that. I also have a slightly different strategy from most VCs. Most VCs are right now trying to save their losers. And by that, I mean that they are spending a lot of time and money trying to lift these up. And that strategy, by the way, works, because if you're looking, if you're a chess player, if you don't know any other move, one of the moves you can make is develop your weakest piece, or the piece that is having the least amount of impact, because that's where the biggest opportunity is. My strategy is that I look at companies that have the biggest potential, that are growing the fastest, and so on and so forth, and I want to put more money there. Because if I lose money here, I only lose what I invest. If I make money here, I can 5x, 10x, 20x, even sometimes 171x, and I've done that in some of the early stage investments. I can really increase the amount of money much more. So I'm looking at it more from what can I make instead of what can I save. And that is based on actual information, actual financial information, product launch information, technology, intellectual property, competition, all kinds of analysis. And then I add on my own analysis on top of that. And that's where a lot of Duke students come in very helpful, because they can do a lot of research and they learn something in the process as well. In fact, I posted recently that I'm looking for interns, the next batch of interns that can take course credit or other considerations for working with me. And in the end, they become trained in doing this. And I get to have a lot of people that can help me do things that I can't do by myself.
Which is always a good idea. But now I want to talk about another issue that comes up, especially with our clients. It deals with a liquidity issue. And when you're investing in the stock market, like I can sell, I trade positions whenever I want to, basically, and frankly, a very minimal cost. It used to be pretty expensive to trade. Now it's like next to nothing. But when it comes to a VC investment, similar to real estate, that's not the case. You're going to be there for quite some time. So talk to us about the liquidity issues that you just briefly mentioned earlier in this program.
Yeah. So just stepping back, there are three things that determine, theoretically, there are three things, in my opinion, that majorly influence your return. Liquidity is one of them, and we'll come back to this. Risk is another. The higher risk you have, the higher your expected return should be. And you may have heard of the term risk-adjusted return. That basically means if I neutralize the risk, what is the return? And the third thing is leverage. Leverage, we're not going to talk about much here, but leverage basically magnifies your return or, either way, positive or negative. So let's talk about liquidity. If you have cash in your pocket, that's like the highest liquidity you can have, because you can whip it out and you always have it. If you have cash in the bank, you have to go online, log in, or tap your ATM card or whatever in order to access that cash, and it may take a few seconds. And for that, they give you like 0.025%. I'm exaggerating to make a point. It used to be the interest rates and checking accounts used to be decent, and now the banks can get away with that. Effectively zero rate. On the other side of things, things like real estate and VCs, they have much lower liquidity. And for that, they have to give you better returns in order for you to make it worthwhile. Now, real estate is perceived to have low risk, and they can get away with single-digit returns also at times, or 10% or low double-digit returns they can also get away with. VC has perceived to be a lower liquidity, and historically it has been lower liquidity than real estate. But these days there's a thriving secondary market out there, and that market basically allows me to buy and sell shares in private companies and get liquidity or sell liquidity. And in that market, I am right now a buyer of shares and a seller of liquidity. In other words, I would relieve some of the funds that are in their 11th or 12th year. And well, the reason 11th and 12th year, by the way, is important is because most funds in 2010s were structured to be 10 to 12 years. So if they are in their 11th or 12th year, they are looking for liquidity because they need to close down very soon, or they need to continue in and get bought out and all that stuff. So they are very motivated sellers, and they want liquidity. I offer them liquidity, and in exchange, they offer me a 40% or even as high as 50% discount on the fair market value of their shares. So the bottom line is that the lower the liquidity out there is, the higher the return needs to be. When I'm giving them cash, which is very liquid, they are offering me shares in a privately held company, which typically, if I want to sell, I would have to sell in secondary market, and it may take me a week, it may take me several weeks in order to sell it. And the more liquidity that I buy from them, the higher my return is, and the lower their return is because they are sellers of liquidity.
Okay, another issue that's come up is the J curve. When it comes to investing in venture capital, it looks like there is a curve that for some time you might be underwater. In other words, the company isn't doing that well, and then it surfaces, and all of a sudden it moves up quite rapidly. We've seen that with Google, which for years they did not produce a profit. Facebook, the same way, they weren't producing a profit, they were underwater. And then we've also seen that with Netflix and other companies. How do you know, or how do you predict whether or not this is going to be a J curve that's going to jump up, or it's going to be one of those 90% that fail and go down? How do you get a sense of that?
It's kind of like getting married. I can reduce, by the way, I took a very mathematical and scientific approach to getting married, which is a topic for another day. It's not very romantic, but it is basically de-risking marriage completely. And that is the same thing that happens with investing, is that I'm not going to be able to eliminate risk. I want to be able to reduce the risk. But reducing the risk, I have 4 things that I look at when I'm looking at a startup or early stage investment. I'm looking at the quality of the problem space they're in. So for example, are they in fintech? Are they in crypto? Are they in AI? And the bigger the problem space, the less the risk. The second is the people. So a lot of people look at the second, the people part actually first, and they have their own things, and that's fine. The quality of the people, and there's like a level, for each one of them. I'm just looking at the top level right now. The third is the quality of the problem they're solving. What is the value of that problem to the society, to industry, to the consumers, and so on and so forth? The higher the value, the higher they can monetize that. And the fourth is the potion. And the reason I say potion is because in business school, we like to have 4 Ps of marketing. So this is the 4 Ps of investing in startups. Potion is the same thing as a solution. What is the quality of their solution? So let's look at an example. AI is really hot right now. It has a huge problem space. So how do, check that box. Now let's look at the people. If that box is not checked, we don't need to look at anything. There are lots of people that would just put .ai after their name. So if you, for example, go Nick.ai or Salman.ai, we can raise a few $1 million just because we have a .ai in our name. I'm exaggerating to make this point. The third thing I look at is the quality of the problem you're solving. So for example, there is a company called Make Labs, and what they have is text to code solution where people who are non-technical can write in a problem description and it would spit out the code, and it will do about 90% of the job for you so that you can do the rest of the 10% with the programmers. It's kind of like Cursor. So if you're familiar with Cursor, but it is kind of a higher level of intelligence for that. So I checked that box as well. And now the quality of the solution is that, and actually I already revealed that they can do about 90% of the job. If their solution did only 50% of the job, then the quality of the solution is not that good. If it did 90% of the job, then it's even better. So these are the 4 things at the high level, but this is like it's a whole course in itself, because the standard methods that you learn to value companies in MBA don't work here, because typically early stage doesn't have revenues. Now, fast forward to a late stage company. The late stage company, you have a lot of financial data, you have a lot of product data, you have a lot of data about the people. The principles would remain the same, but you now have more hardcore numbers, so you can make the same analysis in terms of what the future is. In general, at that time, the problem space and people and so on have already been validated to a certain extent. The thing that you need to look at most is that the people that have come in or the people that have left that company. So what is the delta between these people compared to what it is in the past? And my experience has been that companies that retain their top people usually have a higher future value, which is basically what I'm betting on, than companies who don't retain their higher future value. So for example, one of the companies we invested in is Quesky. Quesky recruited the chief data officer or the chief data scientist from Nubank, one of their competitors. And that was a huge win for Quesky. But as an investor, that shows me that this guy who knows these 2 companies intimately and actually has the most important job in these 2 companies is actually preferring Quesky over Nubank. So he sees that Quesky has a higher potential in the long term from where it is compared to Nubank. So Quesky is a better investment because of that, in my opinion.
Okay. Also, the thing is something about building a moat around your company. This thing can be pretty difficult because it's so, unless you get some really strong patent or like Netflix just dominated the market when it comes to serving people the movies and stuff. And then we've seen the video recently that has their moat around the processors. How does a company build a moat around where they can keep competitors out? It's so easy to have a competitor just walk right in. In other words, you do something good, someone goes, oh, I'll do it too. How do you build that moat?
Yeah, so there are 3 things that you can do to build a moat. One is your intellectual property. The other is you just acquire customers fast enough to be able to do that. And thirdly, that you attack a problem that nobody else has been solving, and you are first to market, and you can define the standards for that. And there are, by the way, other ways as well. So that's kind of from a strategic perspective. From like a legal perspective, there are several ways that you can protect your intellectual property. Patents are one of them. This is an example of a defensive protection. In other words, if somebody infringes your patent, you can basically take them to court, fine them, and they will have to pay you. I actually personally like to convert them to revenue generation by asking them to give royalty to my company as opposed to shutting them down, because that's kind of like a win-win. Or sometimes even acquiring that company because they are so broke that they can't pay the fines. There is another way, which is trade secrets, where you don't reveal your trade secrets so that nobody else can copy it. When you file for a patent, you actually have to reveal a lot of trade secrets. And there are other ways as well. We are running out of time. This may be kind of like a topic for another show, but that is a very, very good, how big of a moat a company has around it to protect once it's successful is a great tool to assess the value of the company.
I would agree. And the thing is, I want to thank Dr. Salman Azar, who's the GP of the Azimuth Fund, member of Duke faculty, and hopefully this will help our viewers in the United States and around the world when it comes to investing in a different asset class, which is VC investing. And we'll see you next week on VC Masters. Take it. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let